While Bitcoin and cryptocurrencies have generally been one of the best performing asset classes since their inception, I have some skepticism as to their long-term success. Today I discuss the commonalities cryptocurrencies have with a Ponzi scheme, as well as the weaknesses inherent with current cryptocurrencies, which make them very speculative assets, so stay tuned. Hello everybody, welcome back to The Contrarian. For those of you who are new here, I call this channel The Contrarian because I typically come to different conclusions than the majority of investors out there. I basically look at the facts and the fundamentals and I ignore the sentiment. And I'll make a disclaimer that this is not to be taken as financial advice, and I don't have any sort of vested interest in whether you own cryptocurrencies or not. I'm just trying to let you know what I see as potential problems right now. So to get started, let's define what a Ponzi scheme is and also look back at some notable past Ponzi schemes and the commonalities they have between each other. Key takeaways of a Ponzi scheme in that, similar to a pyramid scheme, the Ponzi scheme generally generates returns for older investors by acquiring new investors who are promised a large profit at little to no risk. And both fraudulent arrangements are premised on using new investors' funds to pay the earlier backers. And companies that engage in a Ponzi scheme focus all of the energy into attracting new clients to make investments in order to make it work. That's pretty obvious. So in order to function, a Ponzi scheme needs newer investors to always be pumping in more and more liquidity in order to pay off older investors. Now obviously this doesn't mean that cryptocurrencies are a Ponzi scheme, as they are simply tokens, each investor is purchasing. But cryptocurrencies have the potential to behave in a similar way of original investors only making a profit off of purchasing a cryptocurrency should the price go up from where they bought it. And in order to sell it at a higher price, there must be some newer investor willing to pay this higher price in the hope that it will go even higher. So now we know what the basic definition of a Ponzi scheme is. Let's look at some notable characteristics of past Ponzi schemes. Number 1, a guaranteed promise of high returns with little risk. Number 2, a consistent flow of returns regardless of market conditions. Number 3, investments that have not been registered with the SEC. 4, investment strategies that are secret or described as too complex to explain. 5, clients not allowed to view official paperwork for their investment. And 6, clients facing difficulties removing their money. So right off the bat, you can hopefully recognize a lot of these characteristics within the world of cryptocurrencies right now. Number 1 definitely applies. People like Anthony Pompliano or Michael Saylor are always out there on social media promising, some new, always higher price target for Bitcoin or other cryptocurrencies. Bitcoin is going to hit $100,000 this year, or it's going to hit 5 million by 2023, or whatever they're saying. And in doing this, they have, up until this point at least, created a somewhat self-fulfilling promise by drawing in new investors willing to drive up the price of Bitcoin in the hope that these price targets are met. And these people are pumping crypto also do not point out the risks inherent with any new asset class, and especially with cryptocurrencies. And they also don't allude to how overall market fluctuations could affect and have affected cryptocurrencies. Looking at number 3, there is very little, if any, regulation currently in the crypto world, hence why cryptos are the perfect money laundering tool and are often used for this purpose of anonymously transferring money outside of government-controlled systems. Number 4 definitely applies to Bitcoin in that it is still unknown who or what Satoshi Nakamoto, the supposed creator of Bitcoin, is. And while Bitcoin bulls claim that this doesn't matter, I do not agree with that. For all we know, Bitcoin could have been a tool created by the NSA or some other foreign government, investigative agency for tracking money laundering. It's the perfect tool for money laundering, so it's just not knowing who created it is just such a loose cannon. So cryptocurrencies definitely meet number 4 of secrecy and just not really even knowing how many of them came into existence. I would say number 5 and 6 don't necessarily apply, but I would say that in general, the people buying into cryptocurrencies, at least right now, who are massively speculating in, they don't oftentimes know what in fact they are buying. They are trusting that it will continue to go up. They're trusting that they're buying into this momentum that'll continue going. But cryptocurrencies, as you can see, do have a lot in common with past Ponzi schemes. So now that we've covered this, I will talk about some other reasons why, in my opinion, you should avoid cryptocurrencies, or at least realize why they are very high risk. And you won't hear these concerns from those who are promoting it, and they only point out the price and the momentum appeal of cryptocurrencies, and they do not point out the risks, and if anything they at times attack those who are skeptical. I might get a few comments below this video attacking me, but I don't really care about that. Number one, Bitcoin is not a decentralized or democratized currency, and I'll just give you some hard facts here. China, Russia, and Iran collectively control 75% of the Bitcoin hash rate, and China by far leads any other country at 65% of the total Bitcoin hash rate. So this is definitely not decentralized. This is definitely not a democratized currency, hopefully you can see that. And none of these three countries are friendly with the United States, and there have been studies suggesting that Iran has used Bitcoin as a way to avert sanctions imposed on them by the United States, and instead of using dollars to trade oil with Russia, now they're using Bitcoin. So what does this threat to the control of the US dollar as the reserve currency mean? It could mean that the US government will impose significantly tighter regulations surrounding Bitcoin or banning it altogether. Put yourselves in the shoes of the US government. Do they want to lose control of the reign the US dollar has had, or do they want to make it impossible for other countries to avert these sanctions? They do not want to lose control, and they do not want to lose control of the ability to sanction other countries. And shutting Bitcoin's network down is entirely possible for them or any other developed country to do at an expense of roughly $500,000 an hour or $4.38 billion per year to shut down the entire Bitcoin network. And this is peanuts for basically any government around the world. So bottom line is that even if proponents point out the fact that Bitcoin has not been shut down yet as a sign for that going on, it appears that this is not true. It is entirely possible for Bitcoin, the entire network to be shut down through various ways, and all of these other cryptocurrencies as well, because they are not decentralized. If anything, they are mostly centralized in one country, and in Bitcoin's case, this is China. A second reason why I'm very skeptical of cryptocurrencies is that cryptocurrencies' increase in price is entirely dependent on continued liquidity from new speculators or momentum-seeking hedge funds or investors coming into the system. And if anything, this has reversed in the past and crashed cryptocurrencies significantly. Because of this, looking at times when liquidity has flowed out of the stock market, the same thing has happened with cryptocurrencies, but the moves have been significantly higher. Bitcoin has crashed over 80% 3 times now since it was created, and while some might say that this is not an issue, it definitely could be during a prolonged bear market, which cryptocurrencies have never gone through. Think about the typical person who has put money into Bitcoin or Ethereum or Dogecoin in the last few years from Coinbase or another exchange. Are they experienced investors? By and large, no. Are they willing to sit by while their investment crashes 80% or more? Usually no. And during a prolonged bear market, would they be willing, would they be likely to pull money out of the system? Definitely, most of them would. They probably would be in need of that. They're generally not experienced professional investors who are just willing to sit on things for a while. So in my opinion, this will likely crash the price of cryptocurrencies significantly when another bear market does come. All these speculative investors will frantically sell and the prices will drop as they have in the past. And the last issue I see with cryptocurrencies is central banks are creating their own cryptocurrencies as we speak. What does this mean for all these pre-existing cryptocurrencies? I don't know exactly what it means, but what could it likely mean? It likely means that the government see the threat of existing cryptocurrencies, that they pose to fiat currencies, and they are creating their own digital currency, to replace the fiat currencies. So in my mind, the next logical step after creating your own digital currency to replace your older, fiat currency is getting rid of other alternatives, whether they be gold or silver or Bitcoin or Ethereum or whatever. So all of this being said, I don't have any sort of personal vendetta against cryptocurrencies or Bitcoin or any of them, but I'm just very skeptical of their long-term success. What the end game ultimately, ends up being for all of these needs to be seen. Only time will tell that. But this hopefully gives you a better idea of the risks you are taking on, with speculating in the world of cryptocurrencies. So if you liked this video, give it a thumbs up. If you didn't like it, give it a thumbs down. Let me know why down in the comments, and I hope to see you again.